How does the straight line method differ from the written down value method in accounting? Firstly, straight line method spreads the cost of an asset evenly over its useful life, otherwise economic life. The formula to calculate depreciation using the straight line method is depreciation expense is equal to cost of asset minus salvage value, the whole divided by the useful life, otherwise economic life. Here, the depreciation expense is the same each year. For example, if a company purchases a machine for $10,000 with a salvage value of $1,000 and an estimated useful life of 5 years, the annual depreciation expense would be $10,000 minus $1,000 divided by 5 is equal to $1,800 per year. The written down value method, on the other hand, is also known as the reducing balance method. This approach depreciates an asset by a fixed percentage of its book value each year. The formula for depreciation using the written down value method is depreciation expense is equal to book value at beginning of year multiplied by depreciation rate. Here, the depreciation expense decreases over time as the book value decreases. For example, if a company uses a depreciation rate of 20% on a $10,000 machine, the first year's depreciation will be $10,000 into 20%, which is $2,000, leaving a book value of $8,000. In the second year, the depreciation would be $8,000 multiplied by 20%, which is $1,600, and so on. Here are the main aspects where you find a starking difference between these two methods. In the straight line method, the depreciation expense is the same each year, while in the written down value method, it decreases over time. The book value of the asset changes differently in each method. In the straight line method, it decreases evenly each year, while in the written down value method, it decreases more rapidly in the early years. The straight line method is often used for assets that depreciate evenly over time, like buildings. The written down value method is useful for assets that have higher depreciation in earlier years, such as technology equipment. For example, consider a company that purchases a computer for $2,000 using the straight line method with a useful life of 4 years and no salvage value. The annual depreciation would be $500. However, if the company uses the written down value method with a depreciation rate of 30%, the first year's depreciation would be $2,000 multiplied by 30%, which is $600. The second year it would be $1,400 multiplied by 30%, which is $420, and so on until the book value reaches 0.